On January 3rd, 2025, the president signed Executive Order 14178, creating a federal working group on digital assets. Their mission? Deliver a national game plan for digital asset policy. Now, fast forward to July 30th, 2025, and the report drops. Here's the kicker. The word tokenized shows up over 60 times in 166 pages, a clear signal that the cabinet is pushing for the tokenization of real-world assets and traditional financial instruments, as well as the market infrastructure to support tokenization in the US. But here's the real question. How can you, as a startup innovator, compete in a space currently dominated by early players like Circle, BlackRock, and Fidelity? Stick around. We're going to give you a playbook for outpacing crypto giants and TradFi incumbents, even if you're starting small. Welcome to TNF Takes, the go-to spot for crypto companies and on-chain organizations. Before we dive in, if you like this content, make sure you hit the like, subscribe, and alert buttons so you continue getting top-tier content for your crypto company or on-chain organization from industry experts who have been around the block. I'm Noah Buxton, and I'm here with my partner from the network firm, Jeremy Nau. We're here to help you establish trust, build efficient crypto operations, and stay ahead of the curve in an ever-evolving industry. $600 billion in tokenized assets. The president's working group findings suggest a potential 25x increase over today's RWA market. What's more, the cabinet's report seems to acknowledge what we've been saying here for over 6 years. The evolution from finance on paper to finance online and now finance on chain is inevitable. That's right. US leadership actually notes that technological enhancements are necessary to create valuable financial products and the distribution of those products. The working group outlined the specifics of how to tokenize assets. They referenced regulatory structuring and even mentioned key tokenization and Oracle infrastructure players like Ondo Finance and Chainlink. Lastly, the working group reiterated 15 actions that they've taken already to reform the SEC and CFTC, all steps that ready the US capital markets for a wave of tokenization. So no wonder firms like BlackRock, Franklin Templeton, and Goldman Sachs are developing their own tokenized products. The US is officially open for business. But where does that leave most crypto companies and startups? The space might feel crowded already, but actually the opportunities are still boundless. So how can you differentiate yourself from the crowd? After a decade serving the industry and working with top tokenizers, we think it comes down to the 3 Ds: distribution, distinction, and disclosure. So, as I said, I'm here with my partner, Jeremy Nau, someone who served the space for over 10 years, and I think we'll do a little interview style. I want to pick Jeremy's brain on the 3 Ds. So I think we can kick it off with distribution. What does this mean? Why is this a key part of the playbook?
Well, the challenge for all tokenized asset issuers is actually getting their tokenized assets in the hands of users. And that could be a problem for a lot of tokenized asset issuers because they might not have the rails to gain wide distribution themselves. They might be a startup. So how are they going to get their tokenized assets in the hands of millions of users like they want? So there's a couple different approaches that we would suggest that can really help streamline your distribution of your tokenized asset. So the first winning approach that has shown great success in the market is partnering with other massive platforms that already have distribution built in to their system. If you think about Circle and USDC, what was their partnership? Well, they effectively had the Center Consortium and partnered with Coinbase. Coinbase already had millions of users, and they enabled the easy purchase and redemption of Circle directly on the Coinbase platform, instantly getting access to millions of customers. Distribution solved. Circle, I think, has been the best example of this, but there's been other examples in the marketplace too. Think about PayPal, for example. PayPal, of course, created their own stablecoin in conjunction with Paxos, but they have the PayPal infrastructure for payments for TradFi or normal payments that they can simply embed PayPal PYUSD into that workflow, instantly getting their stablecoin right in front of millions of users every day. So I think this is a huge potential route for issuers to go. It might be hard to find a partner that has a massive distribution platform, but if you can, definitely the first place to start, I'd say, to get that early distribution.
Awesome. Yeah, I think I've used this example before on a TNF take, but I do always think about the Starbucks points, essentially, Starbucks on the app. Frankly, I don't use it, but my wife holds the keys to the Starbucks wallet. But yeah, just the sort of tokenization in that regard, it's not a stable coin. It does not run on a public distributed ledger, of course, but it is a tokenized money. And there's a ton of it in that system, in that Starbucks system at any one point in time. And so, yeah, they have that distribution, right? They have that very wide distribution, physical locations, etc. I see other players that have massive distribution or network effects, I guess you could say, in another way, like Facebook was interesting as like a contra example, right? Maybe they were just too early with the Libra project, I believe it was, right? But the idea was launch this stablecoin. It becomes immediately operable and usable across the Facebook platform and probably the other products as well. So I've heard rumors about that kind of coming back. I don't know where that stands.
Yeah, but it's a great point, right? It's like these social media platforms, they would be in a great position to be able to get their hands in a stablecoin in the hands of millions of users, because they already have millions of users. I think Facebook, Twitter, Telegram, right? These would all be in a great position if they weren't explicitly banned under the Genius Act. But we'll see if they find some loopholes.
I think RWA issuers as a broader set, I think about stablecoin issuers sort of within the larger set here, have a huge opportunity here because, again, maybe the Starbucks app, again, just sort of proves the point, like the tokenization or PayPal, even right before having a stablecoin, like the tokenization on a digital centralized database is really not a big problem and has been around for a long time. And so then I wonder, like moving money online, yes, it's difficult. Yes, traditional banking, we complain about those rails, and stablecoins do solve a big problem there. But I think the other stuff that's really more locked up is the big opportunity. And that's, I think, where a startup issuer can really find a foothold in the market because they can bring something to that distribution platform, to that exchange, or again, could be a, sort of Facebook, a social network, a retailer, a large retailer. They can bring a technology issuance package, the ability to issue a financial product or tokenized commodity, for instance. And that's like something that the original platform can't do as easily on their own. It's a much bigger jump, I would think. And it unlocks a less liquid market that's potentially more interesting for users as well.
I think a good example of that is like Kraken. They leverage back finance with tokenized stocks. And maybe the Kraken engine is kind of purpose built for digital assets. So they needed a digital asset form or an RWA to be able to offer those types of instruments on their platform. So that might be an example that you're kind of referencing there.
Awesome example. Exactly. Unlocking that very core TradFi capital markets, publicly traded securities use case and bringing that on chain, making it interoperable with DeFi markets and supported by those Oracle networks we mentioned, like Chainlink. Very cool. So what else? What else in this bucket? Is there anything? Is that it? Just find a big partner, or are there other?
So yeah, there's a couple other more maybe unique or less, obvious distribution paths. So coming to this idea of, you kind of want to build a moat wherever you're doing this, right? And have a distinct distribution advantage. So if we go back to the concept of an RWA, really what an RWA is a tokenized version of a underlying real world asset. And that real world asset needs to be held by a custodian, typically, right? Think tokenized stocks, they have to be held at brokers. But if you have commodities or you have other types of instruments, right, those actually need to be held physically somewhere. So the idea with this approach is effectively to have a strategic partnership with a custodian that is, the largest player in holding that asset. So if you build that strategic advantage with the custodian, let's say you're the only one that they partner with, and they're the largest market for custodying that asset, you're going to have that distribution advantage because you're effectively then the only player that can tokenize asset, or you have access to the most units of that underlying asset that you can therefore then tokenize. So let's say we work with a company that tokenizes certain enriched commodities, and those are very hard to hold safely. There's only maybe 3 custodians in the market, and one of them is the dominant player. And they've developed a unique relationship with that primary custodian, making it very hard for new entrants to come into the space and actually to tokenize that asset. So, all in all, what is that approach? Is to find that dominant custodial player who is willing to build with you and build a moat in that market.
I like that one. And then I think the other thing around distribution is, I guess maybe we've seen other upstart or early issuers, they don't have a vertical integration like we talked about in that first one. They don't necessarily have a custody partnership, but it seems like maybe they're focused on sort of the true or the native crypto market. They're looking for like to be the most operable or exciting on like DeFi exchanges or DEXs, or have like yield bearing opportunities through DEXs. Is that, I think that's another.
Yeah, that's a great, because we talked very much about traditional paths, right? We talked about, hey, partner with large incumbents in the space or partner with large custodians in the space. But the beautiful part of crypto is DeFi and these new infrastructure rails that are being built. So that means there's new DeFi protocols. That means there's new blockchain networks, right? So you can partner with these infrastructure players in crypto and be the dominant RWA on that chain or in that protocol. So, for example, partnering with the DEX, right? They could offer earning of course you have pairings on the DEX, but you could partner with them to, oftentimes they'll have boosted rewards, right? You can partner with them to, instead of earning that reward in the underlying asset or in their, the DEX token that we oftentimes see, is that they can use your RWA as the boosted reward, getting your stablecoin or your RWA in the hands of many users of that DEX. And if they're a large DEX, that could be hundreds, thousands, or tens of thousands of users off the jump. Similar approach with up and coming blockchain protocols. Oftentimes these blockchain protocols are trying to get usage. They're trying to get a lot of different assets issued on their chain. If you can pick that blockchain network that has the ability to grow, and you're a core component of that at the ground floor, you're going to be a key and a widely distributed asset on that chain if you can get in at the ground floor with that new project.
That's a key point. Yeah, that's a good one. I think, we've worked with a client in the past, right? This was part of the business model. It was a successful business model, right? New L1 doesn't have a stable coin, and there was a season where that was really a big problem for new L1s. It's sort of, the market sorts it out, right? There's an incentive there for others, but they were sort of the first to do this on sort of a service basis. Like, hey, go to the foundation that's running the L1 and say, hey, we can support getting a token on early. I thought that was a really unique business model, and I think it worked out well, for a period of time there. And I guess the thing that in my mind kind of cuts the other way here is we've talked about things, it's distribution. It's looking for these large distribution networks, network effects, existing market, sort of liquidity and participation, and you want to jump in to sort of where the party's happening. I don't know if I'm, selling crafts or something at farmers markets. I want to probably go to the biggest farmers market and have the most foot traffic. I want people that come to that farmers market, and I want to get a booth there so I can sell. I think the same is true probably for a token issuer net. I think you could be one of just a few booths at the small town market or the upstart farmers market in my example. You might get a little more attention, but you don't have the foot traffic. You don't have as much volume potential. So yeah, that's an interesting one, kind of pick and choose on the L1s.
It's a little bit more of a gamble, right? Yeah. But it's really developing a relationship, because if that L1 grows, then you're going to be in a primary or a good position, right, to grow with them. They'll give you preferential treatment. You'll be there at the ground floor. So it is a little bit more hit and miss. Right? Like you said, there's not going to be foot traffic day one, but maybe when the farmer's market becomes huge, right, you still have the primary booth or the best location with the most foot traffic.
Yeah. Yeah. Gosh, I guess if I think like we've been, our first stablecoin issuer that we served, was 2018. We've seen a lot of things come across our desk in those years. And I think there has been some seasonality to this, or some, there's different themes to these seasons. But one thing that kind of has been around for a while I'm thinking about is, I guess maybe it goes to the custodian point you raised. Sorry, going back a little bit. But the idea that you have some party, it could be a government, it could be, a sort of family office or sort of a center of wealth, let's say, a company even that holds a significant amount of a commodity, and they want to sort of make that liquid. I think that's an interesting case for even a tech-focused startup issuer to find a partner like that. I think that, but it's interesting because do you need to start with, let's say, we're the largest holder of diamonds, or we've seen diamonds, other precious gems, obviously metals of different kinds, gold, and then sort of going down the list to more exotic, less liquid markets. A lot of times it's sort of pitched as, well, there's a player that holds a ton of this now, right? And we're going to go tokenize that. What do you think? Is that a good play? Does it matter that there's a lot of it to be tokenized, or does it matter more so that there's a lot of participants in the market that might want to put $1 in, and receive some claim on that?
I think it comes down there's a lot of tokenized gold issuers, for example. It's how can you differentiate or distinguish yourself from those? And you kind of need to have a leg up somewhere, like distribution, for example, like we're talking about. Like if you have tokenized your gold, but it's on an obscure website, no one knows about it, they have nowhere to buy it, nowhere to sell it, nowhere to redeem it, then it doesn't really matter, right? So it really comes down to that ease of use, those rails, and liquidity at the end of the day for that market to gain significant market share.
Yeah. Well, I guess you said it. It's like that distinction too. So maybe that weaves us into our second bucket here in our playbook, distinction. So yeah, I mean, what are some of the distinguishing factors that you've seen? Can you kind of categorize them a bit or boil them down to, what has historically over this, short period of RWAs, relatively short, been compelling to the market, right? Who's gained the market attention and been able to grow the business on it?
Yeah. I mean, ultimately, the more unique your RWA is, the better opportunity that you're going to have. If there's 20 money market fund issuers or there's 20 gold back issuers and you want to issue one of those types of tokens, there's obviously going to be a lot more competition. So if you can have a unique RWA, maybe you're the only one tokenizing a certain commodity, or you can build you're basically tokenizing a financial product that is unique, then that can really distinguish yourselves from in the marketplace. So a really unique one is Athena. They've effectively tokenized a delta neutral strategy on ETH, which was, the first of its kind to huge success. They have billions in AUM. So I think this is really where there's an opportunity to be creative as an issuer. You don't just have to tokenize commodities or tokenize financial instruments, right? Tokenize combinations of these things, or tokenize just the yield part of these things, or just certain elements of these things. We were talking to like a carbon credit issuer, and they were going to tokenize certain certifications of certain batches of carbon credits to distinguish themselves. So there is really an opportunity here to be very unique. So that's the first thing, obviously be unique. And then of course, I would say the second one is, people love yield, especially in TradFi, what is the cash flow? So if you can tokenize an instrument that is yield bearing, you'll see obviously better uptake. BlackRock's BIDL, of course, BlackRock has massive distribution, but they have distinguished themselves in the marketplace to have a large market share. But, maybe your asset doesn't natively have yield embedded into it, but you could partner with platforms or partner with dexes or even wrap the token to offer a yield instrument or a yield bearing element on top, which could distinguish your token as well. Obviously, yield is, it's going to get uptake compared to if there's no.
Yeah. Yeah, I think there's a huge opportunity to be creative here for sure. I think, yeah, like we said at the top, sort of a boundless, sort of a limitless, it feels limitless, honestly. Like the President's Working Group report is among the lower numbers we've seen in terms of total opportunity for tokenization. Chainlink has done a lot of thought leadership on this and has, significant numbers, they put out as possible achievements. I mean, Citibank I think, Bank of America, there's been multiple sort of pronouncements over the years, right? Tokenization is coming in. It can be X big in a decade or 5 years. I don't remember all the numbers off the top of my head. I remember Citi, something like
13 or 30
trillions.
trillion. Yeah,
Yeah,
trillions.
trillions. Yeah. And I think that's generally true if you kind of think of all these markets. Good points you made on the, like the options or the delta neutral strategy, right? With their options positions on exchanges, I guess those aren't tangible, right? So they're not the commodity, but we kind of put those in the bucket of real world assets too. Sorry. So getting back to what I wanted to say, is there such thing as too much creativity in this space, do you think?
Well, the more complex with anything typically comes more risk. So you just have to balance that, make sure that you have the proper transparency and disclosure to your token holders. But I mean, I think we're going to see a lot of creativity in the space, and ultimately, the market will decide. But that's how good things are built or great things are built over time. It's that exploration, it's that trial and error to eventually build a product that the market likes. So I'm excited for that element, to be honest with you.
Yeah, I'm excited for that too. I guess I don't want to be too skeptical or the naysayer in the space because I think the opportunity is huge. But I guess if you look at sort of the proof is in the pudding, right? What is the market today? The largest share of the RWA market, I mean, it's vastly made up by tokenized dollars, right? Tokenized US dollars. A set of other currencies are very, very small in comparison. And then some commodities, but mainly gold, right? And even that is a fraction of the total stablecoin market. And everything else is the small tail. And so I guess right now, at least, it feels to me like if it's easy to understand, right? If it's something that people already want and use, if it's either a medium of exchange, or store of value, right? If it kind of has a money aspect to it, sort of a money aspect, or it has a immediate financial product that's recognizable, a tokenized stock, that's pretty easy to get your mind around. I
Yeah.
think that's where the early winners are for sure. But candidly, we've seen some things come across our desk, right? Which, and I guess to the point, I would caution the creative startup issuer here that every bit of complexity or uniqueness or distinction that you create in a product likely has a one-to-one or a one-to-many effect on your internal operations. The risks, like you said, the internal control that's going to be needed to make sure that each step in this complicated process is well controlled so that users can get comfort. And then guess what? Like we're auditors, we're a CPA firm, right? So there's been many cases where I've talked to folks on a call and been like impressed. This is such a cool idea that you guys have. This is something cool you've already built or brought to market or had a proof of concept. But holy smokes, you guys just made your monthly test report about 5 times more complicated than it would have been, otherwise, or it could have been more simple. So yeah, I think that's a cautionary point of creative, but also sort of think about some of these compliance points, customer trust points. Yeah.
And clarity, right? And just ease of understanding. 100%. Like the more complex, the harder it's going to be to communicate to your users. We've seen that so many times, right? It's just like the market's just not ready for it, right? And maybe as the market matures and all of finance comes on chain, there will be those institutional or those players that understand the nuance. But oftentimes in the market, we've seen players be too early, effectively.
Yeah, for sure. Yeah, I think real estate, is something we haven't mentioned, right? Real estate as a sort of asset class that's massive globally, obviously big in the US. And thinking about commercial real estate generally, and I think that's a huge market to be cracked. But there's a great example of where people come with a lot of complexity, and it is complex. Honestly, it is because commercial real estate is usually income producing, right? It's a yield. It has a real property value to it, right? That of course can change with fair market value. It also has an income producing, a rental income stream aspect to it. And by the way, it's got costs, it's got taxes, it's got maintenance, it's got insurance. And so it's almost like you're tokenizing, you're not really tokenizing the dirt, right? You're tokenizing the ownership structure that owns the dirt and owns the right to the income and the obligation to those expenses I mentioned. So it's like you almost have to, it's tokenization of a fund, you could say. I think that's a really interesting area, but I haven't seen anybody really crack that, right? How do you value that property frequently enough for it to be a token that people can trust? How do you in a trustworthy way stream that rental income out to token holders? So I think that's a really exciting one if someone can figure that one out.
Yeah, it's 100%. You're right on hit the nail on the head, though. You're not just tokenizing the building, you're tokenizing all the things that come around it. And that's the hard
part. Yeah. Okay. So, yeah, I think we've kind of talked a little bit here about these aspects of trust or transparency or understandability, clarity. So that probably weaves us into our third bucket here in our playbook, which is disclosure. So yeah, there's a lot here. This is our bailiwick, of course, something we think about and do every day. So break it down. How do you think? Can you kind of bucket this one for us or give us the high points on disclosure?
Yeah, I would say that when people are dealing with tokens, they're oftentimes obfuscated away from the reality that there's actually a lot of trust required for these RWAs to function in practice that the way that people hope they do. Typically, the underlying assets are actually held at an underlying custodian, and what you have is a digital representation or a digital claim on those assets held at a custodian somewhere else. So effectively, there needs to be trust or transparency in all layers of that stack so that your users can be confident that what their digital representation is intended to mean actually is that underlying assets that you're holding on their behalf. So if we were to start at the bottom layer of the stack, typically the off-chain element oftentimes is a third-party custodian. So, I mean, if you are an issuer, an RWA issuer, you need to make sure that you have a reputable third-party custodian because they're the ones ultimately holding the real world asset that's backing all of these tokens that have been distributed. And if that custodian has financial issues, or they go down, or they go bankrupt, so all the assets do with it. So it doesn't matter at that time if you hold this digital representation of a token, if the actual underlying RWA doesn't exist or has been lost or has been caught up in a bankruptcy. So making sure that you engage with qualified, licensed, and reputable custodians to build trust with your user base, especially if your users are intended to be institutional in nature, is going to be key. And not only is it to build trust for your users, but it's to build operational confidence in your own company, right? You don't want to be worrying every couple months that your whole tokenized asset's going to go down because you're reliant on an unreliable underlying third party.
Yeah, and even more so, just boiling that down real quick, the way I think of this is kind of one of these ironic points about crypto, about tokenization, about the technology is you've tokenized, you've created a liability, a representation, a claim, a stake, right? And it can run on a decentralized blockchain and you can hold it and it's self-sovereign and all of that is good stuff. If you take something like gold, I think you're mentioning like a custodian, right? There's a physical metal there in a vault. Like boil that down, a decentralized token and a centralized ledger, right? Yes, there's golden vaults, but what does Brinks do? They manage a centralized database of IOUs. And so, yeah, it's kind of one of those ironic points, but it's super important for startup issuers to think about that level of, custody and the ability for that custodian to provide transparency, provide responses to vendor risk assessment, all the things that you're going to want to know that they're a reliable custodian.
100%, because oftentimes what we see is that effectively what these RWA issuers, they have an account at the underlying custodian and they get a statement saying, hey, you own 10 bars of gold. But those 10 bars of gold might be held with everyone else's gold in the same vault, right? So you don't necessarily have your own serialized gold bars. You have a claim of 10 bars of gold mixed with everyone else's gold. So it's understanding that nuance, the what you actually hold. And then if you can actually have a claim on specific gold bars that are serialized to your name, definitely would recommend that. But at the very least, understanding what risks do come with, having claims at the custodian that we're relying on is pretty important too.
For sure. And that kind of goes back to that, like, okay, well, what is the business model? Like, you have to be clear about the offering, like just staying on gold token, right? Like, is this a gold tracker token? Like, yes, there is a physical commodity or an option put on gold in the back end. So yes, the sort of the issuer holds or can execute on that amount. But is it redeemable for gold? Like, can you trade token into issuer and actually have issuers send you gold in the mail, grams or ounces? Or is this a cash instrument, right? And is it essentially then a tracker, right? And so it tracks price of gold. And with enough liquidity in the market, right, it would be a good way to track gold or hold a stake in that market, exposure to the gold market. I think that's really important here. It really depends. The transparency aspects change significantly, right? Like physical redemption of gold gets probably more to your idea about serialized bars and things like that. Whereas gold tracker tokens, more of the commingled approach probably is acceptable as long as there's sufficient transparency around what's in custody at any point in time.
Yeah, certainly. And then kind of going with that, right? We talked about actually who's holding the underlying assets, but then there's the technical component on top. So you're going to need to make sure that your actual RWA smart contracts and deployments are security audited by reputable firms too. There's a lot of rubber stamp smart contract audit firms out there, and oftentimes those underlying the users or the issuers, they'll have problems with their smart contracts later down the road, right? Either there's a vulnerability that wasn't addressed or wasn't captured, and they pay for it later on. So, in selecting a good smart contract firm, you certainly want to find one that has demonstrated a strong history, right, of reliable audits. In conjunction with this transparency measure, right, you can publish your smart contract code to the public, right, your GitHub repos and the like. And, if something bad does happen, I would recommend, being transparent and communicative to the public. And I think the Bybit hack recently was just a masterclass in how PR is done. Because even though they took 1.5 billion in losses, I think they actually ended up building more trust with their users after the incident due to their transparent communicative nature during the whole event. So, I mean, I think those are key elements of just thinking long term. If you're going to be around for a while and trying to, if you have issues, sweep it under the rug, someone's going to find out, right? So if you can actually be more transparent, it can actually be a differentiator or a reason for people to trust you more and ultimately believe in you to hold your RWA token for the long term.
Awesome. Yeah, that Bybit example, I hadn't thought about that in a while. They did better than Mt. Gox, I'd say that.
I would say that.
Yes. Yeah, that was an interesting one. Interesting study in PR.
And then, of course, the last element, right, of disclosure, right? Of course, you need to have trustworthy custodians and good audits and be communicative during issues. But then there's the transparency element of the underlying assets related to your RWA that's been issued. I mean, transparency can either be a dark spot or it can be a key differentiator for your RWA, depending on the transparency approach that you take to build trust with your community. There's a couple different transparency measures that you can consider when you're issuing your RWA asset. So, kind of the most widespread, at least on the stablecoin use case, and for many RWA issuers out there, is traditional attest reporting by an independent certified public accounting firm. These firms typically confirm at least monthly that the reserve held to back the token exists, are valued correctly, haven't been misappropriated, and maybe have other elements like insurance or a trust structure that can be reported on in addition to the actual amounts of reserves and tokens issued. I actually do expect this to likely become law, especially after Genius, similar to like what stablecoins issuers are going to have to do in the US. I do expect some sort of transparency element to be required for these RWA issuers.
Yeah, and I think on the more bleeding edge, new instruments, DeFi related stuff, I think issuers might still, try to not have a clear home in terms of regulation of those products. But yeah, I think ultimately the customer demand for trust, there's a ceiling for an issuer for sure in terms of adoption and use if they don't have this. I also like how you said these firms, as if there's a lot of them. The truth is, yeah, just for our startup issuers out there who are considering this or pivoting a business or adding to a business, there's not a ton of firms. Of course, we're selfishly interested here. We think we're the best at it and have done it longer than anybody. So we'll, you can ask someone else about that and see if they agree. We think they will. But so then in your experience, on the attest reporting, do you find that that's like pretty well understood by the market. Like I said, there's this sort of market demand or user demand for attest reporting. Do they know what they're asking for? Has that kind of settled into the market, kind of knowing what it's looking for there?
I would say that oftentimes, the retail user might not fully understand. Maybe they go look at the report and they see assets and or reserves and tokens issued, and I think they understand those elements of it. But maybe they don't understand the finer points. However, as these become more institutionalized, and you're trying to get big counterparties to actually use your assets, or traditional financial firms, they're certainly going to understand and be expecting this type of reporting. We've seen demand on that. Like, this is a huge driver of demand, is looking to have institutional adoption or users. And that's where this type of reporting is basically table stakes if you're looking to get that type
Yeah.
of
We've used
usage.
that term before. That's how I feel about it too. I mean, the regulatory support more recently within MiCA and other jurisdictions, the U.S. Genius Act for payment stablecoins, a more narrow set of RWAs, definitely good. But I think that that backstop demand is already there.
Yeah. Yeah, and traditional attest reporting isn't the only type of transparency measures that can be taken. There's other additional things that can be layered on top that can be a differentiator. So, what can actually be done too is that we've worked closely with Chainlink to develop on chain proof of reserves. And what this effectively is publishing the reserve data on chain, enabling it to be used in other different circumstances. Of course, there's the transparency measure of seeing the actual reserve or off chain data on chain that's valuable. But once this data is on chain, it can be used in smart contracts. So that can be used for circuit breakers or insurance protocols or other creative things that can be built once this data is available. So I think this is probably if you pair kind of the attest reporting by a CPA firm plus this on-chain POR via Chainlink or Oracle networks, it kind of bridges the gap for all types of users that might be looking to use your RWA. Right, you have the kind of the TradFi tick mark box checked, and you have that DeFi crypto native user box checked too.
I love it. Yeah, and you definitely had your humble pie for dessert. So I think it's cool to mention, right, that we were actually the first group, us as individuals and a couple other team members that were able to accomplish, again, a true on-chain reserves for stablecoin issuer first, and then also that interaction with the actual smart contract, that important feedback loop or sort of control aspect, right, of saying that contract, the code is by transparency that everybody can see, right? If you go and look at that contract, it's going to say mint request is going to be is checking the reserves. It's using that on-chain POR feed to check whether there's sufficient reserves to be able to meet the mint request to the contracts. Yeah, that's really cool stuff. Like, that's very much automation, transparent control, and then also on chain. I think that's an amazing mix. Very cool for issuers to think about, in their compliance or transparency stack.
Yeah. And yeah, I mean, I think it was a huge innovation. I think it's going to be built in as we think about on-chain finance in the years to come. I think this is just going to be embedded as part of the stack, just because it's such a core component and key control to ensure that these reserve assets exist. And then moving on to the last transparency measure,
Last but
that
not least,
last but probably the most interesting and probably the most novel and innovative is pairing this element of that traditional CPA attestation reporting with that real-time nature of on-chain proof of reserves, is actually getting and combining those two elements to have real-time proof of reserves via an independent CPA or third party to actually issue this information via CPA examination or agreed upon procedures report as frequently as every 30 seconds. So this effectively means that the independent auditor hooks into all the key sources, all the custodians, can pull in the token balances from on-chain, can look at the underlying agreements and effectively report on all of those elements in real time, to provide transparency to both kind of DeFi and crypto native users, but also those TradFi institutional parties as frequently as every 30 seconds. So when we talk about the future, I think this is not only the future of transparency for kind of RWA issuers, but I think this is the future of how the accounting profession is going to look in the future. Just think about the world. The world's becoming more real time. Everything else happens a lot faster, but the audit and attestation world is largely stayed stagnant and slow. But what is that next iteration going to look like? I think this is what it's going to look like. It's going to look like real time assurance provided to RWA issuers.
100% agree. Yeah, we've been living in the future since 2019. I'm glad we weren't too early here. But no, I think you're right. It's inevitable, right? The automation of finance and the on-chain aspects of transparency and liquidity and being borderless and all of the things that are good about it. If you can have the attest technology, the transparency technology and reporting catch up, and be really operable and usable with these new and novel products, yeah, you're going to have markets that are more transparent for users, have more information for, I guess you could say, price discovery and trust and all of the things, right? Information is good for markets. And yeah, I think that gap really needs to be closed. So of course we work on those things on a daily basis, but if issuers are looking into this, I think we also candidly recommend sort of that crawl, walk, run approach, right? Like think about your business model, what is that unique differentiating factor of your offering? Who are the key partners on custody and minting operations and all of that? And what downstream impacts do those decisions cause for your transparency program and ultimately your attest report? If things are getting complicated, that's okay, but probably a reason to start simple. Get that first attest report, get that process up and running, get your team up to speed to understand what they need to produce and when. And then you can accelerate from there into the more real time or on chain. So yeah, as a quick recap, there's that table stakes, sort of monthly attestation report. I kind of think the market is starting to really better understand these, and users are able to be better users, I guess you could say, of the report, more scrutiny, more educated approach to them. So you've got that point in time attest, the on-chain proof of reserves or on-chain reserves feed, as well as real-time CPA attest reporting or real-time proof of reserves.
Yeah. So, I think ultimately, no matter what your RWA is, right, transparency is going to be extremely important. Unlike normal crypto tokens, these tokenized assets inherently have a real world or an off-chain component that must match that digital representation. Certainly be thinking about this at the early stages of your RWA issuance process.
All right. Well, let's put a bow on it. Thanks a lot, Jeremy, for sharing your knowledge here and organizing this so well for our audience. I think, at the end of the day, the tokenized RWA market is set to mint, I guess you could say, or create the next wave of unicorn companies, billion-dollar companies. Only those who kind of lock in their distribution, their distinctive model, and start early with the right sort of disclosure playbook and transparency to their users are going to have the opportunity for big partnerships, the opportunity for an acquisition into a larger group, or the opportunity to address the biggest markets in global on-chain finance. So as we told you a couple of times, we've been doing this for a while. We've seen just about everything that's out there and worked in the details. So love to support you. Contact us at the Network Firm to schedule a meeting. You can find us online at thenetworkfirm.com. You can schedule a meeting yourself and check out the blog as well. That'll come out of this conversation for a deeper dive into the 3Ds playbook for RWA issuers. Thanks for joining us.